Variable rates are holding, but bonds are rising. Should you worry about Bank of Canada hikes? The Bank of Canada recently held its policy rate at 2.25%, no hike, no cut. But at the same time, Canadian bond yields have moved higher, and many of my clients are now asking, should they worry about variable rate increases? What happens next? Hey guys, my name is Katie Shen. I'm a mortgage broker here in Vancouver, and today in this video I will share how you can take an opportunity in this market and improve your overall debt structure to reduce your monthly payments. Let's clarify something important. Bond yields do not automatically influence variable rates. So if bond yields go up, it doesn't mean variable rates go up. Variable mortgage rates move when Bank of Canada changes its policy rate. Fixed mortgage rates move when bond yields move. Right now, bonds are reacting to global factors: higher oil prices, geopolitical tension, rising US yields, not to a signal that the Bank of Canada plans to hike. In fact, the bank's latest message was balanced. Inflation is around 2%, unemployment slightly over 6%, and economy is growing even though the growth is weak. That is not a classic hiking environment. The economy feels like it's balancing on a yoga ball, and the bank is driving with one foot pressing gently on the brake and hovering with a hand over gas, deciding what matters more. So is there a real risk for variable rate increase? At this moment, the probability appears low unless we see sustained inflation pressure, not just a temporary spike in oil prices. Now let's talk about what really matters for many of you. 2026 renewals. Many homeowners locked in mortgage rates at 2% during pandemic, and this year renewals will mean that their mortgage rate will increase up to 3.5% if they're lucky, or even higher. For some, the increase feels dramatic. And here's the common mistake: people focus only on the interest rate. But renewal is not just about the interest rate, it's about your monthly payment and your overall debt structure, especially when your interest rate has doubled. This is also an opportunity to improve your cash flow. If you're carrying credit cards debt at 18% or higher, lines of credit over 7 or 8%, and car loan around 6%, this is your stable rate environment. That may be your chance over the years to improve your cash flow and reset your debt properly. When the bank is holding and hikes not likely, you gain predictability. And predictability allows you to consolidate strategically instead of reacting under pressure. The best financial resets usually happen during stability or predictability, not in panic. Now, fix your variable rate. That still remains the important question, because bonds have moved higher. Fixed rates most probably will be slightly elevated, and variable rates depend on Bank of Canada. And unless inflation meaningfully accelerates, or should I say reaccelerates, the bank has little reason to hike. For borrowers with stable income and some flexibility, variable rates can make sense. And for those who prefer payment certainty, a shorter fixed term may be appropriate. The key is making a strategic decision, not renewing automatically. Bond volatility does not automatically mean variable rate hikes. Remember about that. And if you're renewing in 2026, this may be your best opportunity in years that structure properly and improve your cash flow. Do not just renew, improve your cash flow. And if you'd like to run the numbers and see what structure makes the most sense for you, don't hesitate to give me a call and chat. Let's review your numbers strategically before the market makes the decision for you.